Let's talk about value investing as compared to like growth stocks where you want that price to in the sales and earnings of the company to grow rapidly over a period of time. You're looking for that long-term, that big growth number. Or income stocks that are paying dividends and regularly paying dividends. Value stocks are something that's a little bit different, more of a contrarian approach. Now, sometimes when you look at, let's say, especially mutual funds, they might, in their style box talk about growth stocks that might be in a stock mutual fund and value stocks. But it's really more about value in their case, talking about a value stock. They're considering one that's paying a dividend and more dividend payers. So value and dividends can kind of work the same way, or income. So just be aware whether they're compared the same way. It might not necessarily be an undervalued company. It might be actually be a very strong company that's been paying out a dividend a long time. So you got growth, you get income. Sometimes in mutual funds, they'll associate value with income. But what we want to talk about, how we associate value investing, and you might see the courses and things around value investing, is that's what you're looking for is undervalued organizations or companies. You evaluate companies, you put a value on them, and some might be undervalued or they're hidden gems, right? That's what you're looking for is this. Something has happened and some reason they're undervalued, their stock price is lower than it should be, and it's a great opportunity to kind of buy low. And the market has undervalued them for some reason. Maybe there was some recent bad news, right? Maybe things have been going good, but they announced some bad news and had to close some locations, or their new product is not doing as well as they thought, or whatever. There's some recent bad news that drives the stock price down. And maybe their long-term fundamentals is good, but that recent bad news has really devalued their stock price, so it might be a hidden gem and it's on sale, so to speak, so you can go in and buy this undervalued company on sale. So I think value investing, you're really looking for undervalued stocks that you think will really grow in the market, and you're kind of getting that built-in cushion of a return because they're lower than what they should be is the idea. So to find some undervalued stocks, some key ratios just to start with as far as what to compare to the average within their industry and to their peers is what you want to look at. And these are some ratios. We'll talk more about ratios in great detail, but just to give you an idea of a starting point, you're looking for value stocks that might have a lower price to book ratio than their peers in the industry. Price to book is really talking about, if you were to take their assets and take out their liabilities and say, well, the company is really worth this. This is their book price. If they were to sell the company to another company or liquidate the company, just liquidate it all and sell it all off and sell all the assets like a big garage sale or yard sale, you're selling everything off, that would be the price in comparison to that book value. What is it book value worth? So that would be if it's a lower price to book, well, that means that it's undervalued in comparison to really what its underlying assets are. I mean, I've seen retailers I've gone way down as like, gosh, if you just sold all the inventory, you would make up, what their price should be in terms of a stock thing. They have such a low price to book value. So sometimes that can be an opportunity. So look for a low price to book value. You're looking for a low PE ratio or low price to earnings. So, high price to earning stocks will tend to be those growth stocks. People are paying a higher price in comparison to the earnings that company is actually driving because they're expecting that future growth. Well, an underperformer or an undervalued, I should say, maybe it's a good performer still, but it's undervalued in terms of price or in stock price, will have a low price earnings. Maybe they got great earnings, but their stock price has been driven down for some reason recently. Maybe it's that bad news or something. If the company happens to pay a dividend, it will have a high dividend yield. Where yield, we're looking at the percentage of dividend paid out compared to its price, so it'd have a high dividend yield because the price has come down, but the dividend is the same, so you're actually getting more for your money. The percentage you're going to get out is going to be better because the price has come down on that side of the equation. Companies that have rapidly rising prices as far as their stock price have lower dividend yields. So compare it within the industry once again. And look at things like the future. What's the future look like? What's the growth look like? What's their cash flow looking right? Is their cash flow good? Are they able to pay their bills? Do they have low debt? Things like that might also be good signs around a value investing strategy. And the whole idea of value investing is it's a real contrarian strategy. You might even hear called contrarian strategy, contrarian being opposite, right? If the market says this stock's no good, it's a dog, let's drive the price down, people are selling like crazy. Well, and you're the one saying, no, the market's making a mistake here. I'm going to buy into this because it's just getting driven down way too low. I think there's a good upside in this stock for a variety of reasons. And we'll look at an example here in a moment, one from my own life that I can share with you. But that's the idea that you're kind of doing the opposite of what the market is saying. So it can be very subjective if you think about it. Sure, we can look at ratios. Sure, we can do a lot of detailed analysis. But in the end, you think it's undervalued. Others think it's overvalued and they're trying to get out of it. I mean, you think about just that its nature of stock trade. It's somebody who's selling a stock for whatever reason. They don't think it's any good anymore. Or they're going to do some other things. And there's somebody buying. It's a trade. There's always a buyer and seller. So if you think it's undervalued and you want to buy, that means there's somebody else on the other end who thinks, no, it's not so good. I want to sell it. And they're looking to get rid of it. So they think it's going to go down further, and you think, well, hopefully it's going to go up. And it's also like one thing with value stocks and contrarian investing, it's hard to time the market. It's very impossible to time the market and to buy at the absolute rock bottom. Right? So it's hard to do that, real hard to do that. Experts can't do that. I mean, people do this for a living. Professional people sit in the Wall Street office all day long trying to do that, not successful with it. But you try to buy maybe near the bottom is great with a contrarian or a value investing strategy. So don't be surprised if you're taking a bet on a company, on a contrarian or underperforming company, that it goes down for a period of time right after that. That's natural. That's normal. It might go down as it reaches its bottom for a few months, maybe a few years, for all you know. But if it's a long-term thing, might be so high in the long term, especially if you're looking at holding something like a buy and hold investor and you want to hold it for 10 years, well, you got a lot of time for that to make it up. If you really think it's a great stock that's just been, in the shorter term, whatever the shorter term is, been undervalued. So value investing is great if you like to buy low and sell high. Well, I guess who doesn't, right? If you like risk, because they can be risky, because they could be on that elevator down or that lift going down, and they just continue to go down. They never come back, and you got to get out and capture what you can, because maybe they were a dog, and sometimes that happens. And you want to let time work for you. If it really does go down a bit and then turns around and you're now coming up, you want to let that time, reap the reward of that time, and then you sell it later when it's reached more of a peak or start on that upper end. Once again, you can't really predict the very top or the very bottom, but you're in that range and you're trying to buy it at the low end of the range. So value investing, these are underperforming companies in the market, saying that. They could be growth companies that were growing and now they're a fallen star. They're not growing as fast anymore and people are getting out, so they're getting out of a growth company. They could be a large income or dividend company that has struggled, or maybe they're struggling in making their dividend or whatever, and now they've gone down in value and people are saying, oh heck, maybe they'll come back, and they're investing in them. A lot of times you might see that also after with a large dividend or income company where they're paying out a dividend. If they've had bad times and they cut their dividend, especially in that Great Recession, 2008, 2009, we saw lots of companies cutting their dividend who were good companies. They were just trying to do things to kind of stay afloat a little bit and make the cash flow a little bit better. And if you bought into some of those during that period, their price might have gone way down because they cut their dividend, immediately the stock drops. Well, maybe you get in, and if you're patient, it might come back and they might start raising their dividends again. And then you're now bought low and could sell high or reap the benefits of this dividend by buying it at basically a lower yield or lower dividend yield or at a lower rate because the stock price dropped. So value investing, I do a lot. It's great, and but it's not for the faint of heart because it could continue to go down. So look at some of these ratios, look at some of these things, and in the end, you got to say to yourself, I just think this company is going to do better. I've done some due diligence. I've done this research. I think there's people making a mistake. I'm going to take a risk on it, and I want to buy this company that's on sale.